whilst we help businesses grow, we also help businesses to survive as well, and that's what we do. So demand for our products in times of boom and bust actually is pretty good. We obviously help businesses to grow, but we also help businesses when they've got difficulties. So at the moment, the demand for products is pretty good. And
hello, you're watching Proactive. Joining me is Time Finance CEO Ed Rimmer. Ed, very good to meet you. For viewers not familiar with the story, tell us more about Time Finance and what you do.
Yeah, thanks, Stephen. We're an AIM-listed business. The business was previously called 1PM PLC. Name change was done at the end of 2020 and is now Time Finance. And we effectively provide funding facilities to small businesses. Those typically ranging up to new start companies up to around 10 million turnover. So very much in the small business side of things. And we provide invoice finance, so for cash flow finance and asset finance against fixed asset purchases. So typically hard assets, the likes that yellow plant, diggers, crushers, cranes, transport, those sort of things. So yeah, we provide secured loans as well. And we also provide a mixture of those facilities through an asset-based lending solution, so businesses can tap into either one of those products or all of them. We're not a bank, so we're an independent lender, which means that we have to find our money as cheap as possible from the banks primarily. We then lend it out into the tier two space at a margin, manage those clients and customers, make sure we don't have too many bad debts, and at the end of it, we deliver an acceptable profit for our shareholders, and that's effectively what we do.
And do you target any specific sectors for those small businesses?
Yeah, I mean, it's quite a very well spread lending book that we've got. The biggest concentration is around 13%, which is into the transport and logistics sector. So that's typically businesses that need fixed asset finance against trailers and trucks, and also have a cash flow requirement against paying out those lease commitments, paying out for fuel, and paying out wages to drivers at the end of the month. So that's a favoured industry, but it's quite well spread, as I've said, and that's one of the advantages that we see of the business, that we're not concentrated into any one sector.
Ed, so you said you like to keep bad debts to a minimum, of course. You were on with the third quarter trading update last week, and it looks like you've done just that with your net arrears improving to 5%. That was down from 6%.
Yeah, and we're really pleased with that, because whilst we've grown the business and we've more than just about doubled the size of the business in the last 4 years in terms of the lending book, we've managed to reduce arrears in that time fairly significantly. Originally, from when we came out of COVID, where the arrears were quite a bit higher as most businesses incurred losses and a deterioration in credit. But more latterly, we've managed to stabilize them as we've continued that growth. And they, as you said, they actually came down to 5% in the last quarter. So we're really pleased that the growth that we've achieved has not been at the expense of credit quality.
And your gross lending book also at a record high at the end of February, £210 million. Are you seeing that positive momentum continuing?
Yeah, we are. We saw a little bit of a fallback in the autumn, which is traditionally our busy period, around the budget and all the unease and uncertainty around the end of October. When that was out of the way, things started to pick up again, and we've seen a good start to the year in the first quarter of the calendar year. So yeah, we're pretty pleased with where we are, and we're now into our final quarter of the financial year as we run up to the end of our 4-year cycle, actually, which is at the end of May this year.
So Ed, while you've grown your lending book to that record high, you've also grown the margin. So profit before margin, 40%. So that's increased as well. Tell us how you're managing to do that. Is it tight cost control at the same time?
Yeah, well, I think what we did when we came out of COVID was that we supported all our workforce, but the reality was that we had probably a few too many people when we came out of COVID, because the volumes had gone down. All the government funding schemes obviously jeopardized our own products, but when the funding schemes stopped, then obviously the demand came back for our products. So what we've done is that we've not really increased the head count when natural wastage has been evident. So we've managed costs that way. And we are having much more focus on efficiencies moving forward. That's a key part of our future strategy. So making sure that we make use of better systems, and also challenging ourselves around how we do things. So processes and procedures, lots of things are done the same way as they were always done, and there's actually better ways of doing things now by utilizing technology, and that's a key part of our growth strategy for the future, growing but in a more efficient way. So we do see profit margins increasing throughout the course of the next 3 years. Probably not at the extent that we've achieved over the last 4 years, but certainly getting our target is to get them to mid 20s in terms of net profit before tax margin.
As you said, it's a balancing act between the rates that you borrow at and the rates you obviously give to your customers and the loans to your customers. How are you seeing the markets environment at the moment, with growth really not taking off in any big way at the moment, and quite sticky inflation and interest rates?
Yeah, really good point. I mean, in terms of our own raw material, that's obviously cash, so we have to borrow the money ourselves. Thankfully, we've got a number of long-term finance partners in place, and we've added that over the last 12 months as well with a couple of new providers. So we don't again have all our eggs in one basket. We do have a wider spread of funders, and we're happy with the rates that we get charged. Very market competitive, and we're happy with the people that we work with. In terms of our customers and the market, it's very tough. Small businesses have had numerous challenges over the last few years. Obviously, COVID and the challenges of coming out of that. Then interest rates increasing, insolvencies have increased. Obviously, supply chain disruptions, with the geopolitical challenges that everyone's got. So it's not an easy environment. I think the one thing that we are really confident about is that SMEs are pretty robust. We've seen many sort of commentators around there going to be an influx of insolvencies, and insolvencies have increased, but actually small businesses are pretty robust, and by their very nature they're entrepreneurial, so they find a way to survive. And whilst we help businesses grow, we also help businesses to survive as well, and that's what we do. So demand for our products in times of boom and bust actually is pretty good. We obviously help businesses to grow, but we also help businesses when they've got difficulties. So at the moment, the demand for products is pretty good, and that's also assisted by the fact that the banks typically tend to rein in things a bit, focus much more on risk. When things get more difficult, that's just what banks do, and that puts opportunities into the market for alternative lenders like ourselves to capitalize on. So, market conditions are really difficult, but actually that plays into our benefit, for want of a better speak.
Well, Ed, I hope you'll keep us updated on any additional progress. Thank you very much for the introduction today.
Thank you very much.
That's Ed Rimmer, the CEO of Time Finance.